Good afternoon, Vikes. So today's lesson is going to be a bit different. This is sort of a special lesson. I do have this labeled as Chapter 5, Lesson 5 on the bureaucracy, but it is going to deal more with what the economic impact of the Covid-19 virus has had economically and how the government is going to respond to that. And they certainly have already tried to do that. And it's going to help us to review two of the key ideas that you need to understand we talked about earlier, which is going to be fiscal policy and monetary policy. So I have a lot to share with you. I went off the deep end researching all this today, so there should be some really good information, hopefully. So the politics of policy making in the age of COVID-19. So we're going to look at fiscal policy, which is going to be controlled by Congress and the president. That's the $2 trillion stimulus package that was approved yesterday by the House of Representatives. And then you have monetary policy, which is not Congress or the president directly at all, but rather the central bank, which is the Federal Reserve Board. So it is going to be an independent regulatory agency underneath the executive branch, but again, to be non-political. And they have tools that they can use as well, just like Congress and the president can use to try to battle these severe economic recessions in these types of situations. And this is certainly unique. So I'm going to have more web maps on here today than we've had overall, but I want to explain things to you as we go through. So just an overview of what you'll see from the web map. And again, if you wanted to print it, you could just print the PowerPoint, or you could print certain slides. That's always linked in Schoology in the folder as well. So I linked these video learning, this audio learning, I guess it would be, through a Word doc that you'll see in there, but then also the PowerPoints are there. So fiscal policy is going to be a combination of taxing policy and spending policy that's going to be orchestrated by Congress and the president, and that's what we just saw. This stimulus package, the Senate passed, the House passed, and the president is to sign quickly. I'm not sure if he did yet or not, but will sign quickly. Now, Democrats have a different approach to that generally than Republicans. Now, this is not a normal time, so there's more bipartisanship, thankfully, during this type of crises. So Democrats, we said, typically prefer Keynesian economics and deficit spending, which I'll explain. That was used during the Great Depression, while Republicans tend to control and believe in rather supply side economics. And so trying to cut taxes for the wealthy to increase the supply overall to put people back to work. And I'll explain that as well. And then I'll go through the situation that we have been in now. So the idea of this 2020 stimulus package, which is $2 trillion. So the government expenditures, the government is expending money by appropriating that money directly to citizens. So the stimulus package, in hopes of increasing demand, is what they're looking to do overall. People look at it as free money. Of course, it's not free money. There's nothing free. This is coming out of our treasury, and this is going to put us into greater debt. But again, that's something that has to be done right now, and I completely agree with that. Now, I read a very good article that I tweeted to you out of the Wall Street Journal today, and they said, no, it's not free money, but it actually helps if people think of it as free money, because then they're more likely to go out and spend that money. A lot of people will not spend it. They'll use it on what they need for basic necessities, because it's difficult to prepare for something like this when you're working at a low-wage job. You're working at Walmart, or you're working at McDonald's, or you're working at Subway. It's very difficult to have money left aside, and then all of a sudden you may find yourself out of a job, or with shorter hours anyway. And so it's difficult. And so people will spend money on what they need, and they'll save some money. But at the same time, if we actually go out and spend money as though it's free, then I'm much more likely to go out and buy a big screen TV, or I'm much more likely to go out and to buy something more expensive, a refrigerator, for example, and that's what helps the economy go. It's ironic, we've talked about this before, but fear actually compounds the problem. So I'm worried that I might lose my job. Let's say that I work at a Best Buy, for example, and people are not coming into Best Buy, and actually they are. I went to get a printer yesterday, and it was insane. They have a drive-through lane that you go through. But let's say I'm worried about losing my job. I work at Best Buy, and so I'm going to stop spending money, and I'm going to start saving money and only spend on necessities and that's it, well, I cause somebody else to lose their job. They're going to start saving their money and they're not going to spend much. They cause somebody else to lose their job. And now somebody else that needed a printer to come back to Best Buy, you have a whole bunch of people that aren't coming in. And so my actions actually cause myself to lose my job. So there's times when what's doing best for me is not what's best for you. And it's not what's best for everybody overall. Now, monetary policy is going to be the idea of the central bank, what we call the Federal Reserve, and they're trying to control the money in circulation overall, the supply of money in circulation. And they have three major tools, and they're actually more. I'm not going to get into a lot of this because it'll confuse you and it's not going to be necessary, but I'll run through it one time just so you hear it. But the tools that you'll need to understand are going to be the use of the discount rate, the purchasing and the selling of government bonds, and reserve requirements that are kept for the banks. They can be raised or lowered. So monetary policy, you are literally trying to control the amount of money in circulation. And the Federal Reserve Board can do that through these three areas, which I'll explain on a later slide. And let me point out, I had this on the fiscal slide as well, just so you understand. A business cycle is going to look like this. There are going to be times of recession. If it's an extended recession, something like 3 years straight, then it's going to be classified as a depression. To this point, we've had only one Great Depression, and that was of the 1930s, starting in 1929. So when you're looking at the business cycle, we're looking at gross domestic product, and the gross domestic product, so gross, the total overall, what is produced in the United States, what is actually a finished product. So the GDP would be defined as the monetary value of finished goods and services that would be made here in the United States in a given year, if we're looking at the United States. And then so you're looking at this over time. I really should have had time written here and trough up here, but you're looking at it over time. So gross domestic product here, what is the value of that? And then over a period of time. So you'll have periods of peaks. You'll have periods of recession. That's where we're at right now. Now, the scary thing is, are we right here or are we headed down here some way? And the market is going to do this all the time. So we never know. Sometimes you'll get these recoveries. We had the stock market up 2,000 points one day, and then down yesterday, it was down 900 points, I believe. So it doesn't flow smoothly like this. This is just an economic model for you to understand. When we finally do bottom out, and we're never really sure when that's going to be, then you're in that trough. And then you get back to that recovery. You know, it's interesting as I'm saying this, I'm thinking of the idea we're talking about trying to flatten the curve by staying at home, by keeping your social distance, all of those things. What the Federal Reserve Board and what the Congress and the president will do with fiscal policy, the Federal Reserve with monetary policy, they're really trying to flatten the curve as well. They don't want this to happen, all right? We're in a recession. But if this can happen, even if it goes up and down slightly every so often and we don't end up down here, then we're all better off. And that's what they're trying to do. They're basically trying to impact production. So I'm not going to read all of this to you. Again, you can print these slides, but fiscal policy is the use of government expenditures and revenue collection. Expenditures would be appropriations. Revenue is coming in, and that's going to be taxation. So appropriations, taxations. Taxes come in, expenditures go out. You're trying to influence the economy. Congress and the president, all Congress and the president over here. And you don't pick one or the other, they're done at the same time, and that's what's happening right now. Monetary policy is the Federal Reserve, sometimes called the central bank, sometimes called the Fed. And the idea is that you're trying to control the supply of money that is in circulation. Oftentimes they do that by raising or lowering that interest rate, which we call the discount rate. It's not the rate at which we borrow money. Our banks borrow money off the Federal Reserve. We then borrow money off of our banks. So the discount rate is actually the rate at which our banks can borrow money, and then they will give that break to us slightly above because our bank is there to make money. It's a private institution. And what you're trying to do in each of these cases is to stabilize the economy to reach full employment. All right, so just a bit of an aside here, and I don't want to confuse you with this, but this is sort of a beginning to the review that we will be doing over the next few months to make sure that you're ready for the AP exam. So this is going to be a little bit confusing. This chapter is a little more confusing. It's not something that you readily hear about. but I'll try to explain to you the politics behind policymaking. And what you're going to look at is, are the benefits and the costs going to be distributed? Meaning the idea that it's always perceived. So are we all paying these costs? Are we all paying these benefits? Something like that is going to determine who's involved. If it's concentrated, then you have a small group that is paying. If it's a concentrated benefit, then you have a small group, say farmers, that are receiving the benefit. And so we're going to look at perceived costs. Now, they're perceived, it's not always actual, but we're looking at the cost of a particular policy being put in place. And you're looking at the perception, perceived benefits. What is the benefit? Are we all receiving the benefit or only a few of us? Are we all paying the cost or only a few of us? And first of all, you have majoritarian policy. So majoritarian policy making is the idea that everybody pays and everybody receives. You could look at defense policy, the idea being that everybody pays in. So it's perceived cost because somebody that's homeless, maybe they're paying no taxes whatsoever. But the idea is that we all pay and we all receive protection. Now, an example that I like to use, if we are attacked by the country of Canada and they're going to bomb Ohio, they're angry with Ohio, and the United States Air Force is going to protect all of Ohio except Cummings's house. We're going to let that bomb fall on Cummings's house on Whistler Avenue because that son of a gun has never paid his taxes. He's always cheated the government. That's not a possibility. You protect everybody or you protect no one. In that case, the example that I would use, if somebody does get away with it, which people do, there are people that don't pay their share of taxes or cheat the system, whatever it may be. Those are actually called free riders. So you're getting that protection and you're not paying anything. That would be a free rider. But this is majoritarian politics. We all pay for military protection and we all receive military protection. Social Security could fit into there. We all pay taxes into Social Security. We pay part. Our employer pays part of that. And then that money is put in a trust fund where it grows. And then when we turn 65, we're able to retire and we receive that money. So those are examples of majoritarian politics. You're going to have lots of individuals involved in these issues. Interest group politics would be the exact opposite. So now you're looking at concentrated costs and concentrated benefits. One interest group is going to pay the cost. One interest group is going to receive the benefit. An example from the 1980s, you had some very difficult times in the 1980s and even beyond that, but here in Ohio. So for example, say you have an automobile factory in Youngstown, Ohio, and they're talking about closing their doors, and they don't tell the workers that. You show up Monday morning and your gates are closed and everything's chained shut. There's guard, you can't get in, and you find out the factory is completely closed. You are out of work. Now, there's going to be a period in there where you have no money, you haven't had time to go look for a job, you have mortgage payments that are due, and for most people, they don't have 3 to 6 months of money set aside for emergency situations such as that, such as COVID-19. And so those individuals, those workers were in big time trouble at that point. They have to try to find jobs and scramble. Who are they going to live with? Are they going to be able to pay their mortgage? Are they losing their home? Are they losing a car? And so what the interest groups, so the United Auto Workers would fight for, they fought for a law to be passed, which eventually was passed. Now, I'm not the United Auto Workers, not necessarily part of this, but there was a law passed that said that there had to be 60-day plant notifications before they could close. So your factory had to tell you 60 days in advance before they were going to close so that you had 60 days to scramble. Find out, how are we going to pay our mortgage? How are we going to pay our rent? Do we have to sell a car? Are we going to move in with somebody else? Are we going to move in with parents? That sort of thing. So you had time to go out and look for jobs. The individuals that end up paying in this particular case is going to be the company. The people that benefit, the concentrated benefits, would, in my example, now again, it's partially fictitious. I don't know that it was United Auto Workers, but what you're looking at here is they're the ones that are going to benefit. They get a 60-day notice. So that's a huge benefit for them as opposed to showing up and having no job. Concentrated costs, the factories are now going to have to pay a lot of money. They may be losing millions of dollars a day, and they're going to have to pay that now for 60 days. They have to give that notification. Now, client politics you'll often hear about. Client politics generally pass pretty easily because what you're looking at is a concentrated benefit. So not everybody's receiving the benefit. Talked about the World War II memorial in a previous lesson. Now, we can argue certainly that we all benefit, and we do. I love to go and spend time at that memorial. But the client in that particular case could be World War II veterans. And so this is going to be wildly popular, especially with veterans. Everybody pays into it, so it's not like it's just coming out of my pocket. So everybody pays a few cents, a few dollars into that. And the client that would receive that would be the veterans in that example. Farmers would be a client oftentimes. Farmers are going to receive different types of benefits that we all pay for. And so client politics. Now here, whenever you get a small group that is affected, I should say, you have strong motivation to assemble. So you're going to organize, you're going to get out and you're going to organize at that point because you want that benefit, be it farmers or be it those that are speaking up for World War II veterans, be it the United Auto Workers or be it the Chamber of Commerce or whatever organizations would be representing the factory, whatever lobbies they may have. When you have large numbers of people, so I said a lot of people would be interested in this. They really wouldn't be involved in it, a whole lot of people, because we're going to receive that Social Security. We take it for granted. We take it for granted that we're going to receive military protection, and we don't believe anything would happen. So yes, there's interest in it, but really there's not much organization that goes on by interest groups because everybody pays, everybody receives, so it's not noticeable. Now, concentrated is rather odd. So this is referred to as entrepreneurial politics. So majoritarian politics, interest politics, client politics, and entrepreneurial politics. Now this is a bit different because here what you're going to have is one small group is going to pay, and so now they have a strong reason to organize, and we don't organize because we all receive the benefit, but we don't think much about it because we're all receiving it. And we don't really think about the fact, for example, that I'll use is car safety, automobile safety. So you need what is referred to as a policy entrepreneur. So somebody that is going to go out and fight for the rest of us because we are not going to get organized on this. So you need somebody that will spearhead this. And an example is Ralph Nader. Ralph Nader wrote a book in the 1960s called Unsafe at Any Speed, and he talked about a General Motors automobile. I think it was the Corvair. But I might be wrong. I might be wrong about the company. But he talked about the idea there that these cars are very unsafe, and he showed different types of automobiles, but just going around the corner, Jeeps at times would tip and people would be killed. There was a car in the 70s. I forget which one it was. I don't want to say that now that it's on the air because I don't want to disparage any company, but there was a car where you would actually have just 5-mile-an-hour accidents at traffic signs where somebody was playing with the radio and they would pull up behind and hit the car in front of them, but because of where the gas tank was positioned, the car would end up bursting into flames and people were being killed. And so he argued that we need safety glass, we need seat belts, we need airbags, eventually was argued. I remember being a little kid and riding around in cars and not having seat belts before seat belts were in automobiles. Now those things are all mandatory, and we all benefit, and many of us have been saved by automobile safety devices. Now, we had to have that entrepreneur, Ralph Nader, fighting for that, and the concentrated industry would be the auto industry paying those concentrated costs, or the concentrated group would be the auto industry paying those perceived costs. And it's going to cost a great deal of money for them to do that. And so they went after Ralph Nader very hard, to the point that he was receiving threatening phone calls on his life from people in the middle of the night. Of course, they weren't identifying themselves who they were. So perceived costs, if they're distributed, anything distributed, we're all going to pay those costs. Any benefits distributed, we all receive those benefits, not as much urgency in organizing. If it's concentrated, you're going to pay more of a cost. You know that that cost is coming out of your pocket or your corporation's pocket. If it's a concentrated benefit, you're receiving it and you're going to benefit greatly. So at that point, you're much more likely to get out and organize. Okay, now fiscal policy. So if you need to take a break at any point, guys, of course, you have the ability to pause this. That was a little longer than I intended it to be, but it is important to understand, and that will be good for review for our AP exam. So fiscal policy is going to be the difference between what Congress and the president hope to do as far as taxing and spending. And so fiscal policy, Congress and the president controlling fiscal policy, it's taxing and spending policy. Taxing would be money that is going in. That's revenue that is flowing into the government from the people. All right, so the taxes that we would pay, the taxes that corporations would pay, that small businesses would pay. Spending would be the expenditures. It could be money for roads, it could be money for defense. And in this case that we have going on right now, it is actually stimulus money directly to individuals. Most people in the country receiving $1,200, even if you don't work, even if you're unemployed, you're receiving $1,200. Not sure how that's working out for you because you guys are mostly dependents. So I'm not positive how that's working out for you yet. Now, Democrats prefer what is called Keynesian economics. John Maynard Keynes was a British economist, and FDR and Congress will base many of their policies on Keynesian economics during the era known as the New Deal period. So they're going to use it during the Great Depression to try to get people back to work, referred to as deficit spending because the government must be willing to run a deficit and spend money to put people back to work. And they created all those alphabet agencies, the Civilian Conservation Corps and the Works Progress Administration, on, putting people back to work. The example I use, building Fawcett Stadium. So why would you build a football stadium in the middle of the Great Depression? That seems senseless. No, you're going to put 3,000 bricklayers, concrete workers back to work. At that point, they're going to go out and spend money, and then the butcher goes out and spends money, and then the mechanic at the gas station is able to spend money, so it's going to spread. That's the idea. So used during the Great Depression by FDR. Now, Republicans, on the other hand, usually, now this is not a usual time, but Republicans oftentimes favor what Ronald Reagan did, and he's not the first to do this, certainly, but he did this and becomes referred to even as Reaganomics, which is tax cuts for the wealthy. And people become very angry when they hear tax cuts for the rich. The tax cuts are always going to the rich, and people are always, very angry about that. But the idea is that the rich will reinvest. So supply side, you're talking about suppliers, producers. And so those that own businesses, whether they're small business or whether they're large businesses, those individuals will spend money. They're going to use it. They're going to reinvest. Amazon opens up a new company in Youngstown to replace an automobile plant that is left, something like that. And you are putting thousands and maybe tens of thousands of people to work. They go out and spend money. So no, you didn't get the tax cut because you're middle class or you're in the lower class, you're in the poorer class. So you didn't get that tax cut. But the people that are working at this new plant, they're going to come and they're going to spend, and eventually that's going to work its way into your business. More people are going to come into Walmart, more people are going to get hired, that sort of thing. And so that money will trickle down is the argument. George Herbert Walker Bush was actually running for the Republican nomination against Ronald Reagan in the 1980 Republican primary. And George Bush said that it would not work, that it was voodoo economics. But they mended fences, and later, of course, George Herbert Walker Bush becomes the vice president for Ronald Reagan for 8 years, and then he becomes president himself for 4 years for one term. So fiscal policy. So you have deficit spending. Democrats prefer that. Republicans prefer this idea of supply side economics. Now, what we're getting as far as fiscal policy from our government right now, guys, 220 trillion, in 220 stimulus, $2 trillion, unbelievable amounts of money. The businesses, the airlines, many businesses, airlines being one of the bigger areas that are going to get bailed out. They're going to get millions and millions and millions of dollars, actually billions of dollars for the airlines that they will end up receiving. We are going to get smaller amounts of money. My wife and I will get a total of $2,400. My son will get $1,200. And so we are going to be able to use that money. Now, the idea is to stimulate the economy. So they're giving that money to us. They're trying to increase our demand. We're going to go out and buy goods. So hopefully we'll have some money left over, and I can help some of my small business friends by buying gift cards to different areas. So I can go to some of these smaller stores in town, and even if they wouldn't be open, maybe I can arrange it that I could buy a gift card. And basically at that point, I am going to buy material from them. But for now, while they need that money, maybe they're out of work, that's basically a loan to them until they can get turned back around. So what you're trying to do with fiscal policy, and the same will be true with monetary policy, what you're trying to do is to manipulate the level of aggregate demand, which would be collective or overall aggregate demand. And your goals are price stability, full employment, economic growth, You'll stabilize the stock market and get the stock market back to recovery. And hopefully our trough is up here somewhere instead of as low as I have it. And you'll be going back into that area of recovery. Now, that's the goal. That's not going to be smooth. And I don't think that that's actually going to happen. I don't think we're down here yet. I think we'll go down further. I think that's going to occur once we realize that the curve has flattened out, once we see the number of cases and the number of deaths go down, which they're saying it's going to be a couple of weeks before it peaks. So I don't think that we're here yet because people don't have consumer confidence. They're going to save that money. They're going to buy necessities. They're not going to go crazy until we start to see the light at the end of the tunnel. And then we'll start into that recovery period and get back toward that peak. Monetary policy. So monetary policy is not done by Congress or the president. It is going to be done by the Federal Reserve and the Federal Reserve Board. And they have three major tools, and they actually do have other tools I learned today. So they do have some other things that they're able to do, but we're going to focus on the three major tools that they will use. That's what the AP board will want for our course. So monetary policy, you are literally trying to control. The Federal Reserve, our central bank, is trying to control the amount of money that is in circulation at a given time. And they could be either trying to put more money in, which they're trying to do right now. If the economy is overheated and you have runaway inflation, then they're actually going to try to take money out of the economy. So decrease the money supply at that point so that you can slow the economy, so that the economy will cool and you can slow inflation from occurring. And the three tools that the Federal Reserve Board will use: open market operations, they can raise and lower the discount rate, and they have reserve requirements. So open market operations would be the buying and selling of treasury bonds. And so a treasury bill, you could buy a 30-year T-bill, a treasury bill for a certain amount of money. So I'm loaning the government money, any type of bond, like a war bond. You're loaning the government money. I'm giving you $200. I'm expecting to get $300 back in 15 years or whatever it may be. To raise and lower the interest rate, so the discount rate, again, is the rate at which our banks borrow money. So when we see interest rates in the newspaper and it says it's 3.25%, that's what I can get a loan from my bank. But what our banks can get loans from the Federal Reserve at would be the discount rate. And right now that has been lowered down very close to zero as of March 15th, I had written on one of those papers. Oops, I'm sorry. And then reserve requirements down here at the bottom, the amount of money that must be kept by your bank in reserve. So in their vaults, they have to keep a certain amount. They can't loan out every single dollar that they have there. So the Federal Reserve right now might lower reserve requirements, so your bank doesn't have to keep 20%. They only have to keep 16%. And so they have more money that they can loan out to get the economy going. And then the opposite could be true. If you had inflation, they could increase reserve requirements. So monetary policy, you have the discount rate, so raising and lowering the discount rate, which is the rate at which our banks can borrow money. The government has open market operations, and that's the selling and buying of treasury bills, government bonds. And then you have reserve requirements, which would be the amount of money that our bank must keep on hand. Now, I don't think I'm going to get into these guys because I don't want to confuse you. But right now, in this extraordinary time, just a little bit, I know I always say I won't get into it, and then I do, but just a very little bit. The Federal Reserve Board is now loaning money to banks in a different way. So they usually sell money to banks with interest rates, but now they are loaning money to banks. And so they're doing that, and there will be interest rates to that, but they've actually lowered those interest rates. They also will loan money overseas, referred to as swap lines. And so the article that I read and the videos that I've watched talked about greasing the gears, trying to get more money out there so that the banks can make that more available, so that overseas institutions can make that money more available. And again, the goal is price stability, full economic employment, economic growth. Now, how COVID-19 has thrown a wrench into all of this. So this is a part that I've been looking at today for a good bit and wanted to share with you. So talked about this, but gross domestic product. So the monetary value of all finished goods and services within a country during a specific period of time. Now, what Congress and the president are trying to do is to use fiscal policy to overcome this economic recession as a result of COVID-19, or at least to battle it for the time being until we can get back on our feet, and then we'll head back toward full production. And then you have the Federal Reserve, the Fed, or the central bank using monetary policy, and they're each trying to get more money into the hands of those that are going to be the producers. So attempt to impact production. The Federal Reserve, through taxing and spending policies, they can lower taxes. They offer expenditures through this $2 trillion spending bill, stimulus bill, and then monetary policy. So the Federal Reserve Board uses those three tools that we've talked about. They can raise and lower the interest rates. They have the reserve requirements and open market operations. And then through the consumers, we're getting money into the hands of the producers who will produce more goods, hopefully bring people back to work, who will then go out and they will demand more, and it will continue in that circle. So fiscal policy versus monetary, this is what we're doing right now. So not all of these, but I'll show you. I have arrows coming out. So fiscal policy, the government could raise taxes, they could lower taxes. There's oftentimes an argument here. Democrats believe in higher taxes to create that safety net. Republicans tend to believe in lower taxes, which is that supply side policy. Cut taxes, allow people to reinvest, and that will create jobs. That's a better way to go about it. You have higher government spending, so increased expenditures, or lower government spending. Monetary policy. The Federal Reserve Board can sell Treasury securities. That would be the idea of open market operations, bonds and T-bills. Buying Treasury securities, so they can buy those now, and they can say, we told you that when this matures, we were going to give you $350. You're 4 years from that, we'll give you $350 right now. So they can go out and buy those Treasury bills. Increasing the reserve ratio, the amount the banks have to keep on hand, and then raising and lowering the discount rate. They have just increasing here, but I wish it had said both, and I'm going to change that one for you a bit in a second. So right now what we're doing is that the federal government has lowered taxes so that we have more money in our pockets and we can go out and demand will increase and the suppliers will have more money and eventually they will hire more people back to work, and then you'll have even more demand as workers will have money. And the government has increased spending. So a $2 trillion, the biggest ever in U.S. history, $2 trillion stimulus package, expenditures by the government, putting money virtually in everyone's pocket in the United States, $1,200, whether you're working or not. Again, I'm sorry, I don't know how that affects you guys yet. I'm guessing because you're dependents that your parents are going to get a few more dollars, I think is what it is, maybe $500 or $600 for you, but you're not going to get the $1,200 check, sorry. And then the government, so the Federal Reserve Board, I should not just say the government, but the Federal Reserve Board has increased purchasing T-bills. They've actually gone out and they've bought $370 billion worth of Treasury bills and $250 billion worth of mortgage bills that were out there, bonds that were out there. And then this last part, they're not increasing the discount rate. They've actually dropped that. As of March 15th, they dropped it 1%, and that puts it as close to 0% as I know it ever being, but it is near 0% at which our banks can borrow money. And so it's not increasing, but rather decreasing is what has occurred. Okay, and lastly, and again, don't go crazy. This is more just for your information. This is because of everything that's going on. This is straight economics, all right? This is not something the College Board will ask you, but I want to give it a quick overview just so that you understand how this works. Economics is all about models. So that business cycle that I had that perfect little line. That's not how it goes. The business cycle goes like this. Look at stock market returns. But thank goodness, over time, the stock market, even when it does that, over time it does this. It jumps around, but it increases over time. So as long as you don't need the money this year and you don't panic, then you leave your stock alone and it's going to recover and it will be fine. But if you need it immediately, that's when you have trouble. So this is another model, just so that we understand how things work. So what you get on the outside here, so you have this circular flow diagram, and what we're trying to do right now, because this circle that is occurring has slowed down and we want to speed up the economy. So we're trying to pour more gasoline into the economy through stimulus bills, through lowering discount rates, that sort of thing. So using fiscal policy and monetary policy, we're trying to energize the economy and speed it up. We want to speed up the rate of exchange that is occurring between households and firms. So what happens, we the people are households. So any individual, so whether you're one individual or whether you're a huge family living in a household, you are a household. And those individuals are going to provide things to the firms, the factories, in order that they are able to build goods and services, to create goods and services. And so you have natural resources, you have human resources, and you have capital resources. So factors are what are called the productive resources in economics. And there are three. Sometimes you learn these as land, labor, and capital. It becomes a little confusing then because natural resources, it's not just land. You're talking about wind power now. You're talking about solar power. You're talking about water power. So it's not just land. You're talking about all sorts of natural resources. Anything that is found in nature, it is non-man made, would be a natural resource. Human resources, that's us, so our labor. You could have skilled labor or you could have unskilled labor. The more skilled labor you are, so the more skilled you are, the rarer what you can do that others can't do, the more money you're going to make because you're going to be in high demand. If everybody can do it, then you're not going to make much money. And that's just a sad reality. That's just the way things work in a market economy. And that's what we have is this open market economy. Now, capital resources, that's always a little confusing. Students always want to think of money when we talk about capital. Generally, what you're talking about here is man-made resources, but they're used to produce another good and service. An example would be, so I buy a consumer good. When I need a hammer, so I was doing some work on my garden last night and I was out back hammering away. Well, for me, that's a consumer good. I'm consuming that good. It's not a capital resource. It's actually going to come in to the idea of it's something that I'm purchasing. So it would be out here. So this might be Home Depot, and I bought my hammer from Home Depot. And so now I'm using that hammer around the house. I'm going to consume that to its final form until it breaks and I have to buy a new one. But if I'm a carpenter and I go out and I buy a hammer, then I am going to use my hammer in order to produce other goods and services. At that point, it's a capital good. So it depends on how that good's being used. So a capital good would be a factory. It would be a machine. If I am a traveling salesman, if I always have to travel, then the gasoline that I put into my car would be a capital resource. Now, not for me because I don't use my car to make a living. And so at that point, that's a consumable good for me. Now, these factors are going to be utilized. These factors of production are going to be utilized by the factories, by the firms, and then they are going to produce goods. Our Hoover company that had been here for so many years, and it is gone now, but the Hoover company produced sweepers for many, many years, and they were sold around the world. So a worldwide company. And so they're going to use these factors of production to produce sweepers, and the households are going to be the ones that use those. So we've had a Hoover sweeper forever. And so we purchase our Hoover sweeper. Now, so you get the natural resources, the land, labor, and capital, those productive resources that are going out and they're going into the firms. They turn those around and turn those into finished goods. And as a result, we purchase those goods, and the money that we use is the spending from our household, and that money goes to the firms. The firms keep some of that money. They give money to investors, and then they reinvest most of that money to make their company bigger, stronger, to improve things, research and development. And then they also use that, of course, to pay workers. And so the income goes back to the workers, and the workers are then going to use that money to go out and purchase the goods and services they need. Now, with this novel coronavirus, everything has slowed down. So Congress and the president have put an injection of $2 trillion stimulus package that will go to individuals. So that money is going to go to individuals, households, and a large portion of that money, a bigger portion, will go to businesses. So going to firms, going to small businesses. And so each will get more money so that you can speed this circling up, so that you can speed this process up and get the economy going again. The Federal Reserve Board, using monetary policy, has lowered discount rates and done other things that we've talked about. And so people are now able to go to their banks and borrow money at lower prices, so for those individuals, and then firms are able to borrow money and reinvest in their firms. So as a result, spending has slowed greatly, and they're trying to speed up that economy. All right, guys, I hope that helped you. That is a little bit out of the realm of the bureaucracy, but it isn't in a lot of ways. It's the interaction of all of these branches coming together. And certainly the Federal Reserve Board is a gigantic part of the bureaucracy. So I wanted to just give you that and tie it into the COVID-19 because it all fits perfectly. As sad as this incident is that it's occurring, it is a way that we can learn this lesson and understand the practicality of it. I sure hope you're doing well, guys. I miss you every day. And please let me know what I can do to help. Take care. And big or small, shout out if you need something.